June 17, 1930. The United States signs the Smoot Hawley Tariff Act. History books simplify this moment. They tell you it triggered the Great Depression, but they leave out the most critical detail: the immediate reaction. On the day the tariffs became law, the stock market didn't crash. It rallied. The public exhaled. Investors believed the protection of that era would secure their wealth. They were wrong. The system didn't break because of the signature. It broke when the leg caught up to reality. Fast forward 95 years. August 7th, 2025. The current administration executes a nearly identical maneuver, significantly hiking tariffs on virtually all U.S. trading partners. The average effective tariff rate didn't just inch up. It exploded. Calculated to be 5 times higher than where the year began, logic dictates an immediate crisis. Yet, look at the headlines. Gross domestic product for the second quarter hit a robust 3%. The consumer supposedly remains strong. Mainstream economists are staring at a murky picture, claiming we are merely at the doorstep of the effects. They call this a make-or-break moment. But this isn't resilience. It is a mirage. You are witnessing a phenomenon known as economic latency. While the administration claims we are building the richest economy you've ever seen, the math suggests otherwise. The economy hasn't escaped the bullet. It is simply moving slower than the bullet. We are currently living in the most dangerous phase of a financial cycle, a delay. The quiet months, where the poison is in the bloodstream, but the patient still feels fine. To understand why the collapse hasn't arrived, we first have to look at the illusion of safety we are currently standing on. If you strictly follow the official data released by Washington, the panic seems entirely unjustified. In fact, if you look at the ledger for the second quarter of 2025, the United States appears to be thriving. Gross domestic product, the primary scorecard for economic health, grew at a robust annual rate of 3%. This wasn't a minor uptick. It was a significant rebound from the contraction seen earlier in the year. The narrative from the top is one of absolute victory. The administration has explicitly stated that our country is becoming very rich. They are selling a vision where the trade policies are working, claiming we are on track to have the richest economy you've ever seen. On the surface, the data supports this bravado. The U.S. consumer, the engine of the global economy, reportedly remains strong. Spending is up, activity is high. To the casual observer, the system is flush with cash. But you are not here for the casual observation. You are here because you sense the disconnect between the rich economy on the news and the tightening reality in your bank account. This anomaly, where the data says boom, but the sentiment says bust, is what economists often gloss over. The strength of the consumer is being driven by momentum, not fundamental stability. When reports state that pockets of weakness in the labor market are emerging alongside the spending, it signals that the spending isn't sustainable, it is residual. It is the wealth effect in action, where the top bracket feels richer due to asset prices, keeping the averages high, while the median earner faces a very different reality. Mainstream economists are currently looking at this data and projecting a soft landing. They admit that growth is slower than in previous years, but they insist it is consistent with a safe economic descent. One expert noted that we are only now right at that doorstep where the effects of the summer's policies begin to show. They treat the current moment as a stable plateau. However, record spending in an inflationary environment is a deceptive metric. When the price of big-ticket items like appliances, furniture, and tools begins to pick up, the rise in spending volume doesn't necessarily mean people are buying more things. It often means they are simply paying more money to maintain the same standard of living. The robust 3% growth masks an erosion of purchasing power. The administration defends its policies, claiming we have a great thing going, but the pockets of weakness are widening into holes. The official story is that the economy is resilient. The untold story is that this resilience is fragile, built on the lagging momentum of a pre-tariff world. We are being told the ship is unsinkable, because the band is still playing on the deck, even as the water pressure builds against the hull. But if the surface looks calm, it is only because the wave hasn't hit the shore yet. Let's look at the wave itself. Let's strip away the political rhetoric and look exclusively at the arithmetic. To understand why the economic ground is shifting, you must first grasp the magnitude of the mathematical change that occurred on August 7th. We entered 2025 with a global trade environment that was relatively frictionless. At the start of the year, the United States operated with a 3% average effective tariff rate. This was the baseline, a manageable cost of doing business that was baked into the price of your car, your phone, and your groceries. That baseline has been obliterated. When the administration significantly hiked tariffs on virtually all U.S. trading partners in August, they didn't just turn the dial, they changed the machine. If you calculate the impact of these initial Liberation Day tariffs, the effective rate could have spiked as high as 15%. Mathematically, that is a 5x increase from where we stood just months ago. In the world of logistics and supply chains, a 500% increase in tax liability is not a fluctuation. It is a regime change. The administration expects the new normal to land firmly above that 10% average, but averages hide the severity of the specific strikes. When we map this trade war, we see distinct zones of economic pain. The first tier involves our traditional allies in major economies, the European Union and South Korea. Nations that supply high-end machinery, vehicles, and technology now face a flat 15% tariff. The second tier is where the numbers become staggering. Countries like Canada, Switzerland, Brazil, and India are facing rates upwards of 35% to 50%. Consider the implications for a moment. If a component for a US factory comes from India, or raw materials come from Brazil, the tax on those inputs has essentially just become half the value of the product itself. Then there is the China equation. China is on a different track entirely from most other nations. While discussions hover around a 15 to 20% range, the rate is set to soar unless a specific deal is reached. This introduces a level of volatility that makes long-term planning impossible for any U.S. corporation relying on Asian manufacturing. Here is the mechanism that the truth seeker needs to understand. Foreign nations do not pay these tariffs. The narrative that our country is becoming very rich implies that this money is extracted from Beijing or Brussels. That is false. A tariff is a tax levied at the port of entry, paid by the importer of record, which is the American business bringing the goods in. Right now, we are in a temporary blind spot called the negotiation phase. Business owners are currently scrambling, trying to make well-educated decisions about how much of this new 5x tax load they actually have to increase prices by. They are calculating if they can eat the cost to keep market share, or if they must pass the bill to you. The administration admits this could be inflationary, but the full transfer of wealth hasn't happened yet. The bill has been printed. It has been handed to the American importer, and very soon that importer will hand it to you. So if the tax is 50%, why hasn't the price of your coffee maker doubled yet? The answer lies in the warehouse. The most dangerous illusion in economics is the belief that cause and effect are simultaneous. They are not. In the complex machinery of global trade, there is always a gap between the trigger and the explosion. We call this the lag effect. Right now, you are walking through the aisles of your local store and seeing prices that seem relatively stable. You might look at a price tag and think, the tariffs didn't hurt me. This is a fundamental misunderstanding of how logistics work. You are currently looking at the past, not the present. The reason you haven't felt the full force of the 50% tax hike yet is due to a phenomenon called inventory absorption. The wash machine you buy today wasn't imported yesterday. It was ordered 6 months ago, manufactured 3 months ago, and cleared customs weeks before the August 7th deadline. It is pre-tariff stock. It sits in a warehouse, shielded by old contracts and old prices. This warehouse shield typically lasts between 3 to 6 months. We are currently burning through that shield. We are standing in the eye of the storm. The source material confirms that we are right at that doorstep of seeing the real effects. As one analyst noted, by the beginning of the fall, we're going to have significantly more clarity. Why the fall? Because that is when the old inventory runs dry. That is when the new shipments, the ones hit with the 15 to 50% tax, arrive on the loading docks. But before the price tag changes, something more sinister happens inside the corporation. This is the corporate squeeze. When a company is hit with a massive tariff, they don't immediately raise prices on the consumer because they fear losing market share. Instead, they try to absorb the cost to protect their margins. But math is unforgiving. If their costs go up 20% and they can't raise prices yet, they have to cut costs elsewhere. And the easiest cost to cut is human capital. This explains the pockets of weakness in the labor market that are already raising red flags. Companies are firing workers now so they can afford to pay the tariffs later. The softness in jobs is the leading indicator. The spike in prices is the lagging indicator. Business owners are currently making those well-educated decisions about survival. They are calculating exactly how much pain they are about to pass on to you. The administration promises they will throw our tools to ensure this doesn't turn into serious inflation. This rhetoric echoes the disastrous price controls of the 1970s. History teaches us a brutal lesson. You cannot use bureaucratic tools to regulate away the cost of supply. If the government tries to artificially suppress prices while taxes skyrocket, the result isn't stability, it is shortages. The system is currently running on fumes. The contracts are expiring, the old prices are vanishing, and as we approach the fall, the clarity that is coming will not be a relief, it will be a receipt. The 5x tariff hike hasn't disappeared. It has simply been waiting in the queue. Implicitly, this is your final window. The prices you see today are artifacts of a bygone era. Check your own spending and your own reserves before the fall clarity arrives. However, while the prices on the shelf are waiting to jump, the cracks in the foundation are already being papered over by the government. If the inventory lag is the invisible shield protecting the economy, then the labor market data is the smoke machine hiding the damage. For months, the narrative has been consistent. The U.S. jobs market is a source of strength. We were told that employment was the unbreakable pillar of this administration's success. But in July, the smoke cleared. Job growth didn't just slow, it collapsed. The economy added a mere 73,000 jobs that month, a figure that fell well below expectations. This wasn't a statistical margin of error. This was a warning shot. But the true betrayal wasn't in the number released in July. It was in the numbers erased from the past. While everyone was focused on the 73,000 figure, the Labor Department quietly executed a stunning downward revision to the previous months. They took the employment figures for May and June, months we were told were booming, and slashed them by a combined 258,000 jobs. Let that sink in. 250,000 jobs that the government claimed existed simply vanished from the record. This is what skeptics call phantom jobs. The government releases the headline number to drive positive sentiment in stock market rallies, then quietly corrects the lie months later when no one is watching. They told you the economy was robust in the spring. 2 months later, they admitted the U.S. economy had actually been slowing fairly dramatically the entire time. This is not data collection. It is gaslighting by spreadsheet. And while the jobs are disappearing, the cost of living is refusing to die. We are witnessing the nightmare scenario. The economy is cooling, but prices are heating up. Despite the slowdown, we have started to see the effects of inflation in the most likely of areas. The big-ticket items, appliances, furniture, tools, and children's items, the very things you need to run a household, have all picked up in price. In June, practically everything rose. The core measure of inflation, which strips out volatile food and energy to give a clean look, is stuck at 2.9%, stubbornly above the Federal Reserve's target. This leaves the Federal Reserve in a state of paralysis. The central bank has a dual mandate: maintain price stability and maximize employment. Usually they fight one enemy at a time, but now they are facing a two-sided risk. If they cut interest rates to save the dying job market, they pour gasoline on the 2.9% inflation and the looming tariff spikes. If they keep rates high to crush inflation, they crush the remaining life out of the labor market, which is already slowing pretty clearly. They are trapped. The balance they claim to see is actually a deadlock. The administration criticizes the Fed for not lowering rates, demanding cheaper money to fuel the richest economy you've ever seen. But the data proves the engine is already broken. The system is flashing red. The 258,000 missing jobs were the first crack. The sticky inflation is the wedge driving it deeper. You cannot trust the headline number released on Friday morning. You can only trust the revision released quietly on a Tuesday afternoon. The revisions tell us where we were. The models tell us where we are going. And the destination for the next 6 months is not a soft landing. If the first half of 2025 was defined by the illusion of momentum, the second half will be defined by the physics of deceleration. To understand where we are heading, we have to look at the models that Wall Street uses but rarely explains to the retail investor. The most critical concept in aerodynamics is stall speed. It is the minimum speed an aircraft must maintain to produce lift. If you drop below it, the controls stop working and gravity takes over. An economy has a stall speed too. Historically, that number is around 1% growth. Below that threshold, the system loses its forward momentum, and any minor shock, a geopolitical flare-up, a bank failure, or a tariff retaliation, sends the entire engine into a tailspin. We are now breaching that threshold. While the second quarter posted that deceptive 3% number, the projection for the fourth quarter of 2025 is a terrifying drop. Economics teams have modeled an expectation for just 0.8% GDP growth. This is not a cooling, this is an engine failure. When you look at the entire year, the trend line is a steep descent. The forecast of the year averaged 1.2% growth, already down significantly from the 2.5% pace of 2024. But the forecast for the next 6 months is even bleaker. The expectation right now is for no growth in the second half of the year, a flat line where the economy simply moves sideways. Economists are careful to say this is not a recession, but a slowdown. They call it a soft landing. But for the average American, this distinction is academic nonsense. A soft landing where growth is zero and prices are rising is not safety, it is a trap. This brings us to the convergence of the two deadliest forces in finance: stagnation and inflation. By the beginning of the fall, the lag effect we discussed will expire. We are going to have significantly more clarity on how the market responds to the tariff rates. The ambiguity will vanish, and business owners will start making the well-educated decisions they have been delaying. Those decisions will inevitably involve raising prices to cover the 15% to 50% tax hikes. This creates the stagflation nightmare. First is stagnation, where the economy hits 0.8% growth, meaning businesses aren't hiring and wages aren't rising. Second is inflation, where the tariff bill hits the shelf, pushing the cost of living up. This is the worst of both worlds. In a normal recession, prices usually drop as demand falls. In a boom, prices rise, but wages rise with them. In the Q4 scenario, you get the job insecurity of a recession combined with the price spikes of a boom. It is a period where your money buys less, and your ability to earn more of it is frozen. The unpredictable nature of the second half of 2025 is not about if it will be hard, but how hard. The administration believes that staying meaningfully above zero is a pretty good outcome given the policy changes. But above zero is not enough to sustain the debt load of the American consumer. We are moving from a phase of anxiety to a phase of realization. The data suggests that the rich economy was a summer fling. The winter reality is a grind. You need to prepare your balance sheet for a season of zero growth and high cost. The math is inescapable. The buffer is gone, the revisions are done. All that is left is the bill. At the beginning of this investigation, the mainstream narrative called this a make or break moment for the U.S. economy. They treat the future as a coin toss, waiting to see which side lands. But if you have followed the money, you know that is a false dichotomy. We aren't waiting for the structure to break. The break has already happened. The structural beam snapped on August 7th. The sound just hasn't reached your ears yet. When the administration claims we are building the richest economy you've ever seen, understand that they are technically telling the truth. But you must ask, rich for whom? The system is designed to protect assets, not wages. It preserves the value of the stock portfolio at the expense of the currency in your pocket. The rich economy is a fortress for the few, built on the inflation paid by the many. The cracks aren't showing? Look closer. They are in the revised job numbers. They are in the sticky inflation of your essential goods. They are in the silent warehouses filling up with taxed inventory. The government believes they can manage a 50% tariff without pain. The Fed believes they can manage a slowdown without a crash. History teaches us that complex systems cannot be managed. They can only be endured. The data revisions will continue. The soft landing narrative will persist until the very moment it doesn't. They are buying time. The question is, what are you doing with yours?